Hey, how's it going? In today's video, we are going to be talking about what is a refinance and whether or not you should refinance in the first place. Well, before we talk about what is a refinance, we need to understand what is financing in the first place. Now, most people, they don't have six figures of cash just casually sitting in their bank account. So when it comes to buying a house that's worth 2 to 3, maybe even $600,000, they need to come in with additional financing via form of a loan. So when you want to take out a loan to buy a house, you're going to need to talk to a bank or a lender to help you for the additional financing. So what I'm going to go ahead and do is I'm going to go ahead and take a look at an example for us. So let's say that we want to buy a house and this house is worth $200,000. Okay. So if we were to buy this house for $200,000, let's just say we only have 30,000 cash just sitting in our bank account, not no $200,000 of cash. Well, what we can do is we can go ahead, talk to a loan officer and see if a lender is willing to lend us the rest of the money that we need to help buy the house. We are going to go ahead and say we got an interest rate of a 7.5%, 30-year term, and the loan amount was $180,000. So basically, we would come around $20,000 out of pockets. For this example, we're going to go ahead and exclude closing costs just to get the point across. Our principal and interest payment is going to be around $1,260. And then now we need to take into account the taxes and also insurance. So if you're new to home ownership, you need to understand whenever you have a house or property, you now need to pay the local county property taxes. And then on top of that, if you go through a lender, they are also going to require you to pay for some type of insurance. Now, typically there are two different types of insurance, but what we're going to go ahead and do is we're just going to go ahead and just do a blanket insurance. So let's say in total to get this home loan, we are going to be taking out a loan for $180,000. And if we were to add up all the payments together with the property taxes and insurance, we are looking at around a monthly payment of $1,825. Let's go ahead and say that a year passed by after I bought this home, and then I talked to a lender or a loan officer, and they told me like, hey, interest rates are around 5.5%. Now that you found out the interest rate's 5.5%, and you heard about refinances, now you can now understand what is a refinance. And a refinance is basically where you go ahead with that first loan and you find a bank or a lender that is willing to pay off that first loan. And then now you can go ahead and structure a different loan type so that you can basically potentially lower your monthly total payments. So when it comes to a refinance, there are two different types of refinances you can do. You are going to have a rate and term refinance or a cash out refinance. So, but for now, what we're going to focus on is just a simple rate and term refinance. So here we have the rate, which is the interest rate, and then we have the term on how long the loan is going to be when it comes to the rate and term refinance. So let's just say we want to pay off the first loan that we got, which was 7.5% 30-year loan for $180,000, and we just want to lower the interest rate by 2%. What happens when we lower the interest rate by 2%? Well, let's go ahead and let's say we talked to the bank and they told us 5.5% for this new loan. We're going to go ahead and pay off your original loan of $180,000. And let's just see on how that changes our monthly payments. So if we were to reduce the interest rate by 2% and we go ahead and do the same 30-year loan term with the same loan amount, our principal and interest payment is going to decrease by $236 a month. So what that ends up doing is that ends up saving us around $2,800 every year when it comes to the loan payment. Now, if we take a look in terms of the interest, that ends up being around $300 saved in terms of your interest, at least for the first month. Just by getting a lower interest rate, you're going to be saving quite a decent amount of money when it comes to just paying off interest. So if you were to just do a rate and term refinance, you're basically just going to be paying less interest over time. But now what happens when we want to do a cash out refinance? What is a cash out refinance? Well, a cash out refinance is where you basically pull money out of the value of your house. Now, what does that mean? Now, before we talk about what is cash out refinance, we first need to talk about what is property appreciation. So all across the United States for the past 50 years, home prices have been increasing by around 5.44%. But for the case of this video, we are just going to be using just a flat out 5%. If we were to buy a house for $200,000 and 1 year goes by and we stick to that same 5% property appreciation, after 1 year on average, your home value is now going to be worth around $210,000. So what happens after that first year? Well, if we were to stick with this loan and we made the payments, we didn't miss any payments, and the home value increased, we need to see this difference. Here we paid down the loan balance by around $1,300, and the home value is increased by around $10,000 from when we first bought the property. Okay, so what is happening here? Well, first of all, we technically made a little bit of money when it comes to home value. However, I'm not taking into account all the interest we made. And at the same time, we own a little bit more of our home because we paid down that original loan balance. So in an ideal scenario, when it comes to the equity we own in the house, it would just be the difference of the estimated home value and the loan balance. So technically here, we would own around $31,700 of the property. Okay, keep in mind, whenever you buy a house and you put a down payment, that money isn't just disappearing unless the housing market crashes. That money is just being put into a different form of asset. It ends up becoming a hard asset, unlike cash, which is a liquid asset. As you pay your loan off, home values are going to be increasing, let's just say that 5% on a year-by-year basis. So after 30 years, your home is now going to be worth around $864,000, which is almost $1 million. And ideally, because we got a 30-year term and we didn't do anything, didn't miss any payments, we were consistent, we now owe zero to the bank and we paid off that loan for the house. Okay. So now we basically outright completely own our house and we don't have to pay a lender for the house. So what a cash out refinance is you basically go to that same bank or whatever bank you want to go to and you tell them like, hey, I own this property for 100% of the value. How much money can you give me where I give you my house as collateral? So most of the time, whenever you talk to a bank, that number is going to be around 80%. However, this highly depends on your finances and your credit score and also your income. It's a whole deal, right? Let's just say you can get up to 80% of the value of the home via loan. Okay. Now this is going to be a little bit more complicated, but the case should still be the same. So instead of doing the 30-year mark where we don't have a loan on the house, we're just going to make it a little bit more complicated. And we're going to say on the 15th year we own the house, we now want to pull cash out. We want to do a cash out refinance. Okay. So what we're going to go ahead and do is we are going to go ahead and change this to a cash out refinance, meaning that we want to get money out of this property or we want to pull equity out of the property because now at that 15-year mark, the house is now worth around $400,000 where originally it was worth around $200,000, and we paid down this loan balance by around $45,000. What happens here? Well, it's pretty simple. If you just use this Excel sheet, you literally just put the same home value. And keep in mind for these taxes and insurance, I went ahead and scaled it so that the taxes and insurance can be estimated. And then let's just say we go ahead and get that same rate. We get the same rate of 7.5%. And now here's the thing that changes, the loan difference. Let's just say we want to cash out as much as we can and we get the 80% of the home value. So technically, if we were to get 80% of the value of the house in terms of a loan, what we could do is we just multiply that by 0.8 to get 80%. And we could get a new loan of $332,000. Okay. Now, this is where the cash out part comes into account. So like we said that our original loan amount at that 15-year mark was $135,000. Okay. So to have an idea on how much money we would cash out, we would get the new loan and subtract it by our previous loan. So if we were to talk to a bank, they approve us, they take a look at our finances, and they say that we can pull 80% of the value of the house, we can get around, let's say, $200,000 of cash back. However, this does not include closing costs, title fees, appraisals, or other things like that, or even origination fees for the lender. Just keep that in mind, but the point still stands. After 15 years, you own the house, you can now take out another loan to basically cash out on your equity that you have in the home. So in this case, it's $196,000, almost $197,000. But here's the main difference. Because our loan amount increased, our loan payment is going to increase as well. So if we take a look at the difference between our first loan and then we take a look at the difference between our second loan, we are going to be increasing the amount we borrowed via this loan for $332,000, and we are going to be increasing the payment by around $1,067. Okay. So just with this example, you can have an idea on what is a rate and term refinance and what is a cash out refinance. And one of the most distinguishing things that you need to understand is let's say your job stayed the same, you get to pay the same amount, right? If you were to do a rate and term refinance, the main purpose there is to just reduce your mortgage payments on a month to month basis. But when it comes to a cash out refinance, you are increasing the loan amount, therefore increasing your payments just so you can have liquid cash in your hands. And usually what ends up happening is your mortgage payment will probably more than likely increase. But that's a sacrifice we need to take when it comes to pulling cash out. Now, when it comes to talking to a bank and getting qualified and all that stuff, a lender is going to have to take a look into your finances. Okay. So when it comes to rate and term, if nothing's changed about your personal finances, you're more than likely going to be just as qualified to do the rate and term refinance as opposed to a cash out refinance. Because if you're now increasing the loan amount, therefore increasing your payments, you now need to make sure you qualify for that new loan. So that is why there are loan officers to help you for both scenarios, whether or not it's a refinance, whether or not it's a rate and term or a cash out. So that is what a refinance is. If you're interested in getting a refinance, please feel free to reach out to me via phone or email. I do own my company called Creative Mortgage, and I can more than definitely help you out when it comes to getting a loan for your house. If you can go ahead and do me a favor, please like and subscribe, and feel free to leave a comment down below if you have any questions. And that is all that I have for today's video. Thank you very much. Bye-bye.